Higher interest rates were here, now they're gone. Since the financial crisis, it's been tough for people trying to live on interest and dividends. They've had to seek out new sources of income while trying to balance the risk of loss against the opportunity for cash at every step. In this environment, Lending Club, an online marketplace for loans, gained national prominence as a meeting place for individuals wanting to borrow money and those wanting to lend. For those not familiar with the organization, it's a peer-to-peer loan agency where individual investors can pick and choose which loans to finance or even parts of loans. It comes with cheaper interest rates for borrowers than they could get elsewhere and often high single-digit returns for lenders. That's a win-win. In effect, the company allows people to be the bank for those who are shut out of the traditional banking world. Yields on such loans range from roughly 7% for good borrowers to more than 15% for risky debtors. Lenders can even build a portfolio mixing and matching types of loans, parts of loans, quality of buyers, all sorts of other attributes. Don't like the looks of a loan? That's fine. Pick a different one. For anyone investing for more income, this business is very attractive. So attractive, it caught the attention of institutional investors. We're talking about hedge funds, big banks, and other large institutions that are now prowling around Lending Club's website looking for deals. There goes the neighborhood. The whole idea was to get away from Wall Street, not build another platform for it to gobble up. Small banks have been using Lending Club for a while, pushing down yields a little bit because they have more money to work with, and it also allowed them to greater diversity in their loan portfolios. But the new guys really mess things up, not because they show up with buckets of virtual cash, but because they bring with them financial engineering. The new guys have crowded out the smaller competition of individuals who have been funding loans, which kind of defeats the whole point. And it doesn't stop there. They're adding credit default swaps, which is a fancy way of saying insurance. Now they can sell fractional shares of pooled securitized consumer loans and offer third-party guarantees. That sound you heard? That's the yield on all the higher quality loans at Lending Club falling to the floor. This is one more example of the mismatched investment world we live in. As populations in developed nations around the world age, there's a greater demand for streams of income. Every pension fund, insurance company, and aging private investor has the same problem. They're all chasing the same type of investment. As institutions squeeze the yield out of traditional vehicles like bonds, individuals sought out unconventional opportunities like Lending Club. Well, now that it's proven itself in scope and size, the institutions are crowding in and taking over again. Individual investors once again face the unappealing choice of accepting lower yields or trying to find the next innovation in fixed income. For us, this will continue until the Fed raises rates back to a suitable level. But don't get your hopes up that that's going to happen anytime soon. For now, when it comes to Lending Club, we're almost right back where we started.